To go. Good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It is Thursday, November the 8th. Oh my God, I've got something on my screen. 9th, sorry. 8th or 9th? I'm sorry about that. 9th. The week's getting ahead of us. I'm delighted to be joined by Rachel Ziemba, founder of Ziemba Insights and adjunct fellow at Center for a New American Security. Amina Bakr, Chief OPEC Correspondent and Dubai Deputy Bureau Chief at Energy Intelligence, and Jorge Montepeque, President and Founder of Global Markets. Thanks so much, everybody, for joining us. Amina, let me start with you. We've seen oil prices slipping in the last week or two, contrary to perhaps what may have been expected a few weeks ago, and certainly down quite a bit, in the last month, from the comfortable 90s down to $80 now, below $80. What's behind this? Is this suddenly that everyone's realizing there are real economic concerns to come? How would you sort of analyze that slippage?
Diela, it's quite surprising to see these levels, to be honest with you, given the amount of geopolitical risk that we have in the region. A few years back, I would even expect oil prices to be up, given the tensions that we're seeing. But it's the opposite. As you mentioned, oil prices slipped under $80 and are still trading under $80 over concerns mainly to do with demand. We are seeing a kind of slowdown in demand going into the fourth quarter now and going into Q1. There are less VLCCs according to data. So this slow start, slow in demand, an expectation of the US Fed hiking rates may further slow down the economy. All of these things are being factored by the market and are having an impact on prices. Now, the big question is, that at the end of this month, on the 26th of November, OPEC Plus are expected to meet, and they do look at various factors. And on top of the collective cuts that they have the voluntary cuts. Yeah. And these voluntary cuts, we were told that initially they were put in place for the scenario that we're seeing now as a precautionary measure in case demand doesn't pick up. Will they be extended? Will they be deepened is something that remains to be seen. But these are the kind of two choices that they have right now. According to our data, at least, if they start easing the cuts going into the first quarter, you're going to end up with a huge increase in stock levels that I don't think anyone in the group wants to see.
Yeah, so that's kind of that caught between a rock and a hard place, because they'll want to keep supporting, if you like, or keeping a balanced market, as they say. But that could create the opposite effect, if you like. Jorge, good morning. Great to have you with us. Give us your, again, same question to you, really. What do you think is driving these prices to drop when we should be having at least some support from geopolitics? And you can even put Russia into that still. We should be having some support there in terms of what's happening in Ukraine. $15 slip in 1 month. I mean, that's a lot.
Yeah. Well, good morning, everybody. I was at this program, I think, nearly a month ago, right after the Hamas terrorist attack. And I was with two other guests who were, frankly, very bullish about price direction. And the point I made then, and I would continue to make now, is the biggest thing we're facing is not the terrorist attack, is not the counter devastation of the people of Palestine, of Gaza, is interest rates. Interest rates have been rising steadily as the funding needs of the US continue to grow because of the imbalance between tax receipts and expenditure. Part of that expenditure, of course, goes into the war machinery. But what really matters is that they need, meaning the US government, a huge amount of funding. And then they start draining liquidity out of the entire world because they need to pull the money in to finance that deficit. And that results in a higher interest rate. And that is slowing down the entire economy. That is the one single most important element we're facing right now. And that situation continues steadily with interest rate being higher. And at some point, they exceeded 5% per annum for the US treasuries. And
how is that impacting China, though, for example, Jorge? I mean, obviously, it's impacting America, it's impacting economic activity and that demand for manufactured products from China. But let's just say the sort of actual contagion into the Chinese economy in any way, is that impacting that, inflation, etc.?
Well, money is like water. It finds its general level. It leaks from one area into another. So if the US, who still has a very good rating, is paying a high interest rate, it will draw resources from the whole world. And it will draw some money from China. But very importantly, the additional and incremental investment into China doesn't go there. It should go where the interest rate is higher. And as of now, is the US government, is the one that pays the most assured interest rate. Therefore, as the issue in the Middle East happens, the instability grows, the possibility of a broader war, which in all the news I have been reading over the past 24 years, it concerns me as a human being and a humanitarian greatly about seeing the continuing killing of children and people, but the potential extension across the area. It's, one would say it's bullish, but it's not. All it means is slows down the economy further because it's additional sand and additional grit into the overall economy, because capital is also going to start fleeing from those areas. Who wants to invest in this section of the world right now? I don't think anybody reasonable. You will study it, you would analyze it, but you wouldn't commit capital. So the biggest issue is, again, interest rates, is the rate of return on investment.
Okay, thanks, Jorge. Rachel, let me go to you with that point, both those points. First of all, what's your impression in terms of the American economy? Are there signs there that it will start to, or is starting to slow down because of these interest rates? And I'd like to also hear your views on what Jorge just mentioned on sort of investment climate for the Middle East. I mean, we've had so much bullish sentiment until about a month ago with the plans between the Gulf and the Levant, etc. Is that now all dead in the water, would you say, from an American perspective, which obviously America was pushing hard for that as well?
Yeah, well, maybe not dead in the water, but all the headwinds are more so. So let me talk about the U.S. and China economy just very briefly. So the U.S. economy, I think there are signs that it's going to slow. I mean, what we saw so far have not yet been meaningful slowdown. If anything, what we saw in the third quarter data was that industrial policy was supporting manufacturing, that consumers maybe partly skewed by things like people going out to the movies to fight over Barbie and Oppenheimer, and people going to Taylor Swift. I mean, even things like that, really led people sort of to spend some of their money. But people are drawing down the savings that they accumulated during the pandemic. And interest rates are going up, credit card delinquencies, auto loan delinquencies, a variety of those things are going up. And anyone that needs bridge financing, so it's not just the US government paying high rates, but anyone with bridge financing, that's increasingly costly. And so some of the impacts of, for example, the credit crunch in the tech sector that we saw earlier in the year, that's starting to bite. Now, is this a recession necessarily? That I'm not sure. But I do think after some surprisingly strong economic data, that's slowing down. Now, with China, I think in some ways the trajectory has been a little bit reversed. There's been this great hope that economic activity was picking up, that energy demand was picking up, and to some extent that has happened. But some of the energy demand seems to have gone into filling their strategic reserves. And Jorge's right. Yes, money gets pulled to higher interest rate locations. But I also think that there are domestic reasons in China, the weakness of the property markets and other dynamics that have meant that there's not this push of money and capital into China in this way. China, by the same token, because the capital's not coming in, not pressing on the exchange rate, they're not turning around and buying US assets. They're also not turning around and doing a lot of investment in BRI projects and so on, the slowdown we've seen. So I think it sort of all adds up to, you know, a more sluggish demand picture. It's probably not, in a Chinese context, weak enough for them to do this sort of big round of stimulus that the markets keep hoping they'll do. This is not the Chinese government of 2010. So I think you do end up with some more sluggish environments. And we do have this sort of geopolitical drag. For the oil markets, I think how that manifests, though, you know, I've you know, not only on this podcast but other places, sort of talked recently about the fact that in many ways in the region, what one would really need to see happening are Iranian supplies sort of, you know, coming offline either due to sanctions enforcements and the like. So you can have a lot of human cost without there necessarily being a major market response. I still think, you know, congressional bluster aside, I don't think the US is going to do much to really take these additional Iranian barrels offline, or even the Russian ones, but we'll see how that goes.
Yeah, absolutely. And I mean, you know, then most of them are going to China, those Iranian barrels, and the US has no appetite probably to do that, and no capability maybe either. It's not its priority, let's say, in terms of its relationships with China. Amina, let's just go back to OPEC and just talk a bit about, I mean, clearly, if prices remain at 80 and below 80, counterintuitively to what they should be maybe doing. But as we go into 2024, of course, just you know, most people have been saying, well, they're going to have to probably cut more next year just to maintain a desirable sort of balance, if you like, from an OPEC perspective. But also the other thing that was going to happen next year was a serious conversation about quotas and essentially reversing cuts for countries like the UAE, et cetera, who've been really waiting for that moment. So how is that going to impact things?
Diana, just let me say overall, if we look at the OPEC production numbers for last month, we've been noticing a trend that they've been increasing production collectively. Our latest data for October shows that the group collectively have a production of over 43 million barrels. That's around 320,000 more than the previous month. So but gradually there has been an increase. There's been a slippage in compliance levels. The Gulf states have been faring well. I mean, the Saudi Arabia complies to the cuts in addition to the voluntary cuts. But if you look at other states, that's not the case at all. Iraq, Russia, etc. You mentioned the baseline issue. Yes, that's something that is going to be discussed at the upcoming meeting, but they're only going to be talking about the African countries that they've asked independent companies to verify their capacities. Those numbers are going to be reviewed. And then into 2024, there's going to be a revision for all the member states' capacities. But there's no intention to change the baselines of 2024. There are going to be no changes at all. Any changes are going to happen in 2025. So there's a kind of sense that there's going to be a level of stability in 2024. But given the current prices, given where demand is going, given the slippage of compliance, there's definitely perhaps more room for the group to announce something more, tighter compliance, extending voluntary cuts. So yeah, these are all options on the table for the time being.
Of course, and Saudi and OPEC have said they will continue to sort of manage things on a monthly basis, quite tightly. Jorge, I mean, let's talk about supply because the market seems to be in agreement that there's plenty around at the moment, no disruption from tensions, and there's non-OPEC supply also coming aboard, but more of that. And one of those is America and the US, which has again reached its peak rates of production. And of course, we haven't had you on since we've seen these two big M&A deals announced in the shale patch, Jorge. So give us your view on that, whether you think that's going to sort of push US production comfortably above the 13 million barrel next year and onwards. You know, when just a few months ago people had said, okay, it's plateaued, forget it, US is not going to sort of be increasing anymore.
Well, as a first element, price is always a function of that intersect between supply and demand. And production in a market where everything works on a free market economic basis, not by government mandate, really. And the US is a free market in terms of production, leaving aside the environmental niggles and constraints. It's really a free market. And at the level where we are in right now, call it 80, actually even call it 70, because we could actually drop as low as that, but not much more than that. The incremental production of shale is still profitable. There are, of course, many different prices at which there is a break even, depending on the area where you are producing shale. But above 60, that machine can keep on producing. The oil companies will continue buying each other, trying to gain more efficiencies in the area, but incremental production will continue to go up in the US. Of course, there is a debate about whether the numbers are counted properly insofar as the gravity of the oil, or whether they contain too many other normally considered gas liquids. But the fact is that there is more production in the US. And the fact is that the US will continue to export a lot of its domestic oil because it's not what many of the refineries there prefer to run. So I think exports in 2024 will hit record levels again for the US. So we should see more of that. And that means that in countries where you have the ability to mandate production, they will be under pressure to keep it down, because we had essentially 2 additional sources of supply in the last year that are significant: Iran and Venezuela. Yeah. So the US is holding that lever to ensure we mustn't forget elections, that prices don't get out of control, and they have essentially let those 2 countries produce more than they were in the past. So it's really a geopolitical structure. And that makes the job very hard for Saudi Arabia, how to manage that so there's not a price collapse.
Yeah, back to the 2014, 2015 days, maybe when we had that price collapse because of this whole shale, particularly influx into the market. Rachel, just on this Venezuela point, it's the 6-month window that's been given for reinvestment and reproduction, if you like. There, is that just based on, okay, as long as Maduro does what he's promised? But do you expect that to be extended, given what Jorge just said, gives the US much more control over controlling prices and keeping them in check?
So I think this is another important thing coming up later this month, which is going to be sort of clarity on what some of the electrical framework they agreed to last month, and some rulings from the State Department about whether what has been done so far is sufficient. There were some red lines set up about allowing fully free and fair elections, which is something I don't see the Maduro government being willing to do. I do think the U.S. administration at this point is probably going to be a little more flexible about it than some other folks might like to see. So of course there is a risk that it could be terminated even before the 6 months are out. As a result, but I would, they're set up to continue being rolled over, as we saw with things like the Iran sanctions under, the meaningful reduction measures and the like. I think the dynamics, Jorge's right. Yes, that there has been some additional volumes from Venezuela this year. If anything, the bigger change, there was an upward movement there, and there'll likely be more in volumes. But the bigger move was that more of it went to the US and Europe, more of it was at closer to market price, as opposed to a dynamic that Venezuela had before, which was that all of it went to China, and China could set the price, and it was through illicit channels, and the like. So I do think that this dynamic, the sanctions overhaul, the limitations on payment, because yes, investment is allowed, but all of Venezuela's banks are still sanctioned. A lot of entities are sanctioned. I think it really privileges the entities already in place in Venezuela or those who are collecting on debts and claims there. So my expectation is that production is going to drift up somewhat more slowly just because of the sanctions overhang, this uncertainty about how long the sanctions pause is going to remain in effect. And this sort of very complex debt web that is still out there.
Yeah. Thanks, Rachel. Amina, let's talk about sanctions and Russia. I mean, obviously it's under sanctions. The price cap is still in place for what it's worth. But we have seen also that the discount from Russia offering its crude has been weakening, let's say, or changing throughout the year. India's been taking more of its oil. I'm not sure how much China's taking these days, and at the same time, Russia has been, releasing and tightening the valve on the products exports that it wants to give to Europe, etc. So, what's the outlook for that going forward next year in the market? Is there any nervousness by even OPEC producers, not OPEC Plus, that it's unpredictable in terms of what Russia may do with its crude and with its products, and how is that going to impact the flow changes that we've seen this year?
Yeah, you touched on a really good point. I mean, and the fact that Russia has kind of exceeded everybody's expectations in terms of how much they were able to defy these cap sanctions and make sure that their oil reaches Asia. And yes, there has been a kind of almost a little bit of a displacement, I would say, from some of the Middle Eastern crudes into Asia because of the Russian discounts, which, of course, here, if you talk to any of the national oil companies, they'll tell you that they have long-term contracts and therefore they're more reliable, etc. So this doesn't pose a concern to them. But the outlook for Russia, yes, absolutely. There's a big question mark on where it's going. And one of the things that we understand that will be discussed on the November 26th meeting is Russia's current capacity, its production levels, and the ministry will be asked to give projections of where they see their production is going into 2024 in order for the group to be able to assess how this will be calculated. I mean, according to our calculations, at least, Russia isn't really meeting its quotas. It says that, I mean, theoretically, it's supposed to cut 300,000 barrels a day from its exports, which we have them not doing. So they need to provide the group with more clarity on where they're heading. But largely, Diala, if you look at it, symbolically, it's really important to have Russia as part of this group. And I don't see any kind of tensions arising because of this issue. Russia sees the importance of staying in this alliance given the ongoing conflict, the war in Ukraine. So it needs, to be part of a group that it's accepted in. And for OPEC Plus, yeah, having, a major producer like Russia still makes sense. So in terms of like internal dynamics, I don't think that's going to impact, the unity within the group per se.
They're going to keep them on board at least, regardless of their sort of compliance. And obviously, the impact on their industry may also accentuate next year in terms of functionality. There's our question for today, which we've been discussing. Whether they'll need to cut further next year. It looks like they will. At the moment, I would agree there, but will they definitely need to cut? Is that a definite yes or no, as things stand? And we'll see what we get from there. Jorge, just to go to you on the sort of, again, back to sort of the inflationary side of the argument, for example, but in relation to oil and shipping, because we've had, of course, this drought in the Panama Canal. We've had a few people commenting on this in the last week or so. And of course, that's having an impact on possible flows of not only oil, but other products. What's that doing in terms of pushing up supply chain again and back into the picture as a concern, and inflation, obviously, with shipping costing more, etc.?
Well, to me, these are essentially, I hate to put it in this way, but entertaining issues, right? Every once in a while, the Panama Canal either has not enough water, and that's why they use lake to satisfy those requirements. There are changes in the weather every once in a while. And also, sometimes they need to upgrade their systems and rebuild the locks or some issues. So this is periodic, but it doesn't affect the world at large. It just adds extra time to some of the shipments, but it's not a big blow.
Yeah, I mean, extra time and extra cost at a time when we're trying to bring costs down is my point, in terms of the inflationary pressures on economies. So you're saying it's not something exceptional that's going to add any extra pressure?
It's something temporal, right? It is definitely temporal. In fact, everything is. What I think is more important is the overall slowdown in energy consumption in Europe. That is deeper. Whether a ship takes 1 month or 6 weeks now to reach another area, it's a temporal issue, important, but not so important. The slowdown in Europe, the really serious situation happening in Germany is far more important. Of course, in terms of the big economies, we spend a lot of time ourselves here talking about China and the US, but we need to speak about the second tier. Germany is now consuming overall less BTUs, fewer BTUs than in 1990. They really have a serious trouble. And the advisors to the government have indicated that their growth is going to be just a little bit over close to 1% as opposed to over 2%, where they were hoping. I mean, they can keep on hoping. They have lost major market share into China. They lost the access to cheap commodities, and they keep on diverting resources into wasteful war equipment. So Europe is seriously having a hard time. And this is why prices are not rising. Right?
Okay, and why do you think Germany has sort of gone off the rails a bit this year? I think it surprised quite a lot of people, didn't it? An economy that's usually very well managed, even given obviously the challenges Europe has, obviously as a bloc, it's not doing well, inflation, etc. Interest rates have gone up, obviously. But why has Germany had such a hard time when it should really be the one that usually shows the most planning and control?
The German economy is built, in my opinion, on 3 legs of a stool: good engineering, access to very cheap commodities to build what the engineers are saying, and an export market that is global. China, the rest of the world loves German equipment. But very critically, one leg of the stool fell off, which is the access to cheap gas, cheap metals, cheap coal, cheap everything. So essentially, they're falling off that stool. They haven't quite crashed to the ground, but they're teetering on the verge of collapse. This
vulnerability to gas, obviously, that's a huge one, which Germany's been paying for all year. But they have also made some transitionary, I suppose, emergency measures, right? They've managed to get more LNG cargoes in. They're working on changing that infrastructure as well going forward, having learned their lesson about Russia. Do you see this problem continuing, or do you think give them another few months, they'll be back on track if they get that?
No. The problem is continuing, because if you can get a commodity delivered into your factory to turn into plastics at a price, and I'm going to make it up here, say, of $2, and instead you're forced to buy something that comes to the US and lands at $8, then as an exporting machinery, as a seller, you cannot compete with anybody else. So all the manufacturers in Germany are exiting the country. All the additional investment is not happening there, it's happening elsewhere. The German companies are actually de-investing. So they have to realize, and I think they will have that big realization next year, that if they don't become friends again with Russia, the bust as an industrial state. the migration to China and other countries, the US, will continue. So Europe is the one that has paid very much for all these sanctions. It has been, and I have been calling it since the beginning, is the boomerang effect. You don't hit your target, you hit yourself. And that is damaging the overall global economy at large and the prices for energy across the world, because energy is not being used efficiently anymore. So there's less consumption.
And of course, that there's a big shift in terms of manufacturing, not just from Germany elsewhere, but from China to India. India has been a big recipient of a lot of that relocation, if you like, for geopolitical reasons. Let's have a look. There's our result. 55% agree that they will definitely need to cut output. I mean, again, who knows? But it's certainly a market that's managed quite tightly and consistently. So we wait to hear. Well, thank you so much, everyone. We've run out of time this morning. Thank you to Amina, to Rachel, and Jorge for joining us. Have a good remainder Thursday and Friday, and a great weekend ahead. Thanks so much, everyone. All the best.
Thank you.
Thank you.
Bye-bye.
Bye-bye.